Again, I mentioned the only direct thing we do is student lending. And that's at market rate as well. We got about $1 billion of student loans. And again, the only reason there's two reasons we're doing that. One is we're not competing with any of our financial institutions. But another very important reason is it's important for the state to help our North Dakota kids through college. Disasters is a third vertical. And I mentioned those before. We're running 5 agriculture disaster programs. It's a record for us. Typically, historically, we run about a disaster program every 5 years. And now this year, we're running 5 in 1 year. Then we have legislatively directed programs. So I mentioned we're a $10.6 billion bank on our balance sheet. We got $6 billion in total loans, $5 billion commercial ag, $1 billion student loans, and then we carry about a $4 billion securities portfolio for liquidity management. Off balance sheet, we hold $1.2 billion in additional legislatively directed programs. Now here, the best example is, I think I have a slide on it here. The best example is school construction assistance. So the legislature will say, we want to build schools at a below market interest rate. Our interest rate is 2% in North Dakota that we like to build schools at. So the legislature will set aside, I think they set aside $500 million, I think it was 10 to 15 years ago. They give it to us to manage. So because it lines with our expertise to underwrite construction projects, whether they be schools or whatever, we're the best at underwriting the school construction project. What's the likelihood of it to be built on time, on schedule? Does it fit? What's their ability to bond at the end? All those things that we underwrite, that's our expertise. That's another thing that we bring. So we'll approve the schools to go in there, okay, and then we'll use up that $500 million. As they construct, we'll advance those funds and facilitate that from the $500 million that the legislator set aside. But as those schools pay off, let's say they finish construction and they go out and get their final bonding that pays off this revolving fund, it'll open it up, then we'll approve new schools in. So that's a fund that we manage. It's the same thing with infrastructure. So think water infrastructure, sewer, roads, streets for various municipalities across the state. It's a real key partnership with the legislature because we're a tool there to be used by the legislature, by the Industrial Commission that lines up with the strategy of the state. Then we have our mission-based vertical, and this is where we get creative. This is our real magic sauce. Another example is rural housing. We have a problem in North Dakota with rural homes. We have really good people that qualify, great credit, great DTI, in a rural, sub 5,000 community in North Dakota. However, when they go to buy that home or build that home, the appraisal doesn't make because they've got to go too far out for the comps, right? And ever since 08 and 09, the secondary market who buys mortgages, they won't touch it if the appraisal has anything wrong with it or if they have to go too far, if there's too much adjustments. Legislators, governor, what I've learned from them is getting that street knowledge of what's actually going on out in your state is one of the hardest things to do. I think in our meetings, it's been mentioned there's an invisible left behind group in New Mexico. Who are the best ones to get you information and street knowledge of what's going on with that invisible group? Well, for me, it would be all your community banks and credit unions out there who have those as customers because they're the ones meeting with them on an annual basis. They're the ones seeing them come in off the street to do a transaction. They're the ones visiting with them. They're the ones integrated in the community. They're the best source of knowledge. Our 91 financial institutions feed us a lot of information about what's going on in the state so that we can make better decisions. And then we have our state government, which is our legislature, our industrial commission. Those are the gears of really how we work. Here's an example in our core vertical of how our participation loan works. I'll go through these quickly. So we have a customer that has $1 million need and the market rate's 6.5%. Now our lead bank, not us, our Dakota, we'll call it the Dakota lead bank, they're gonna look at that $1 million loan, they're gonna underwrite it and approve it, and they're always gonna stay the lead on it. They're gonna be the one that always meets with the borrower, always accepts payments, they're always the lead, right? But they're underwriting it first. Now, for whatever reason, they might not want to hold that whole $1 million. Now, it could be banks have legal lending limits. Federal regulation requires banks to have legal lending limits, so they're not lending to one borrower. They're lending, spread out. This relationship might be over their legal lending limit. there might be some additional risk here that in their underwriting, they're not comfortable holding just on their own. They want to share that risk. There also may be larger balance sheet structural management that bank or credit union wants to do. They may want a little bit more liquidity on their balance sheet. And loans are not liquid, securities are. So if they are tight for liquidity, they need to do fewer loans and buy more liquid securities. And if they're tight, one of the ways is they can keep doing loans with their customers. They can sell some on the back end to us to have better liquidity on their balance sheet. Those are the three big reasons our 91 financial institutions participate with us. But now we will underwrite the deal as well. And we have a full underwriting team. We will independently underwrite on top of their independent underwriting. And there are times we tell our lead banks, no, thank you. We might be too full on the relationship. We might not like the risk profile. We are beholden to our industrial commission and our legislature to run a proper bank. And running a proper bank means you structure the balance sheet correctly, but you manage the biggest risk in banking, which is credit risk. The risk that your loans will not repay you. So if I run a bank and I let credit risk get out of hand, I'm going to be fired by the industrial commission, as any bank CEO would and should be. So we're very, very cognizant of doing and managing credit risk to the best of our ability. So we will underwrite that. Now here's the real kicker. On average, we'll buy $500,000. The lead bank is going to get the 6.5% rate. We will only get 6.25%. That 25 basis points difference is given to our lead bank because they're doing all the work on that, right? That ongoing administration of that all the way through payoff or maybe even collections. And that's the motivation, additional motivation, and it's just the right thing to do, is to pay them a little bit for their time and effort because they've got to lead the way. So here's a disaster loan. Same $1 million example. We'll still both underwrite it. The lead bank will underwrite it, but market rate's 6.5, but we want to do a disaster loan at 3.75 so that the borrower only pays 3.75. Well, who buys down the rate from 6.5 to 3.75? And this is, again, where we get creative working with the legislature as a state public bank. So we might hold, depending on our strategies as the bank, we might hold all of those on our balance sheet and just buy down that rate difference with our dividends. We might take that earnings hit. We might work with the legislature on an off-balance sheet program where they would set aside appropriation dollars that could be used for that buy down of that rate for that borrower from 6.5 to 3.75. We might hold that off balance sheet, much like the school construction and others. We may hold it on balance sheet, or we may do another creative solution. One of the most successful creative solutions that we have is our PACE program. It's the most widely used interest buy down program in the state of North Dakota, and it's our baby. So that same $1 million loan example, if this is a PACE loan, if you're a business coming into the state and you're going to add jobs, or if you're an existing business in the state who is going to expand and increase jobs, depending on the number of jobs you create, you're going to qualify for a PACE interest buy down on that loan. So if the market rate's 6.5, and let's say you're going to create 25 jobs in the state, you might get your interest rate bought down to 4.75. Now, we will buy down that interest rate through our dividends, but only half or a portion of that. The other buy down has to come from the local municipality. So there you're bringing in skin in the game from the local city commission or county commission who has to get the money set aside to support the PACE program. So it gives them buy-in into the game. And we have a lot of partnerships like that, which are the state, private, and local municipality that we've creatively managed in order to promote things like business expansion and job expansion and things like that. So all of this has ended up with that $5 billion in a business ag loan portfolio. But again, keep in mind our participation rate is 50%, so that's $10 billion out to the state. About $1 billion in student loans. We return in profit about $400 million per year back in net profit. We put a little bit to capital. We're sitting on nice capital of that $1.3 billion, but we dividend about $250 million of that back to the general fund every year. That's money for the legislature to spend wherever they want. Some of it is set aside to fund the buy-down programs, like the PACE program, like specific disaster programs, some other things. We do hundreds of millions in disaster programs. We got the $1.2 billion in legislative programs, and on our portfolio, we renew and originate about $2 billion per year in new or renewed loans out into the state of North Dakota. All that has led to and I think Harold said it, he said it very well. Our entire concept is based on the base concept of, if you want strong communities in your state, one of the best ways to do that is give them strong, locally controlled community banks or credit unions. They're great financial tools. They have that magical power of banking within the community. Again, they're the ones integrated in the community. They understand it the best. And you want Main Street businesses, you want agricultural operations, you want whatever fits that community, mining operations, whatever, that local community bank or credit union is the way to get it done. North Dakota, we have the highest per capita community bank in the nation at 50.9. South Dakota's behind us, Nebraska. I don't know where New Mexico ranks. I wish I had that data for you. I'm sorry I don't. But we're proud of that. And we know we're not all of that, but we know we play a big part in that with our model being Bank of North Dakota. In addition to financial institutions, we serve a big role with our state agencies, our Treasurer's Office, our Department of Water, Health and Human Services, everything, right? We do payments disputes, we do Fed settlements, we do public deposit pledging, CDs, analytics. Some of these are for our financial institutions. We do correspondent services as well for our financial institutions, so a lot of additional work there.